So now let's talk about special orders. Special orders occur when a customer comes to you and asks for a customized product. Or in this case, they're asking for a customized price for your product. Let's consider Bear & Company. Bear & Company produces 100,000 coffee grinders per month. The monthly capacity that they have in their facility is 125,000 units. So in essence, in this normal month, they're only using 80% of their available capacity. Per unit data for the past month, an average one, is as follows. The selling price of each coffee grinder is $20. The variable cost for each coffee grinder is $8, and it comes out to be $4 per unit on a fixed cost basis for each coffee grinder. A special order has been received from North Star Incorporated. They offered to purchase 2,000 grinders at $11 per unit. Let's take a look at what a manager might do in this situation. So based on the provided information, the manager's first reaction is likely, let's not accept this special offer or special order. The reason is that our costs exceed the actual offered price. If we look at our variable costs per unit, that was $8. Our fixed cost per unit is $4. So therefore, total costs on a per unit basis are $12. And that is greater than the $11 price that is being offered by the purchasing company. However, this logic is potentially faulty. The reason is that Barron is under capacity for this month. That means that they're not going to incur any additional fixed costs, and they're not going to save any additional fixed costs if they produce or don't produce these additional 2,000 grinders. The $4 in this sense is irrelevant. What we should be focused on is just the incremental costs associated with producing these additional grinders. And that would be the $8 that we incur for each unit on a variable cost basis. So, a more realistic view of the incremental impact of accepting this order and selling North Star these additional 2,000 grinders is $11 in terms of revenue per unit and $8 in terms of variable cost, the difference being $3 per unit. Again, I've ignored the $4 fixed cost per unit because it's not like we're giving up capacity or we're going to have to build capacity in order to produce these additional 2,000 units. So, each of the additional 2,000 units earns us an incremental amount of $3, which in total is equal to $6,000 additional contribution I would earn from accepting this offer. Now let's assume some additional information. Suppose that the current projected sales for the next month is 124,000 units. That's instead of the 100,000 units normal month. The monthly capacity is still 125,000 units. The question now, will the manager still accept this special order? For 1,000 units, we have capacity to produce these grinders and sell at the offered price. So for 1,000 units, we have additional capacity. We're not using that for any other sales, so we can go ahead and use that 1,000 additional units or that available capacity and produce those for North Star's offer. But another 1,000 would actually cannibalize existing sales. Currently, we're projecting 124,000 units in sales, and we only have capacity for 125. 1,000 is irrelevant. You can use the available capacity. But if we were to complete the whole 2,000 unit order, we would have to take away from existing sales. So for the 1,000 for which we have additional capacity, we would take the $3 contribution margin per unit because the only incremental cost we would incur to produce those would be the variable cost per unit of $8. But for the existing sales, not only do we incur the $8 to make those, we give up the revenue associated with the existing sale. So we would need to cover costs greater than just the variable cost to produce. We would have to cover the lost contribution associated with the existing sales. That is $20 of our normal selling price minus the $8 it takes to produce. That means that we would need at least $12 from North Star to justify selling the 1,000 existing sales to them instead. So in this case, the manager will likely not accept the special order given the offered price of $11. It doesn't cover enough of the cost that we would incur to remove existing sales and sell to them instead. So let's think about some qualitative concerns in this decision setting. First off, we need to consider time horizon. Are we adopting more of a short-term focus, or are we thinking along the lines of a longer-term relationship? A short-term focus would be, this is a one-off deal. This person will probably never purchase from us again, and it's up to us just to consider that in the short term. But if this is leading to a longer-term relationship, our focus might be different. We might consider whether or not this is a strategic alliance that we want to incur in, and perhaps giving a little bit in this transaction leads to gains in the future. The other implications are for this specific customer. Does it set a precedent? Is this customer always going to require or demand this special price? And what about if other customers realize that we've accepted a special order at a lower than normal price? Does that have implications? Will they demand that lower price as well, or deem it unfair? And that could strain relationships with some important customers. So ultimately, in this setting, qualitative concerns might offset the financial perspective that we're adopting. And it ultimately depends on whether we're adopting a short-term or long-term focus, as well as the implications for the current and other customers.